We have a lot going on. The Dow down about 140 points right now. And a lot of people are worried, is it interest rates that's going to dislodge this whole thing? We've had, what, 6 up trading days in a row? Is that in jeopardy here? And what's really going on? Mitch Roschelle is here, PricewaterhouseCoopers partner, business development leader. We got John Lonski here, of course, of Moody's fame. And last but not least, my buddy Lauren Simonetti, FBN AM co-host. She gets in here like at midnight and doesn't sleep. She has a cot in her office and says,
I'm working on that, actually.
No, it's interesting, Lauren. I mean, it's almost as if the markets are going, all right, yeah, we like higher interest rates, but we don't like them if they go too high. Higher interest rates are good if they're reflective of a good economy, but we don't want them going back to craziness.
What's too high? At 3%, I think we're okay with that. I'd go so far as we're okay with 3.5%. Is 4% the line in the sand now? You know, like, what is the worry?
Someone told me you get a mortgage up to 6%.
Yes, Home Depot said that today. Yep. That they're not worried about an impact to their business with home prices and home sales cooling off as a result of higher rates until they get to about 6-7%, and it's been
mortgages.
Quite some time.
Let's say we hit 3%, John. Okay. I think we're just begging for that. It's going to happen. Then what?
4.7% mortgage. Not all that bad. It doesn't sound bad, but remember, not too long ago, mortgage yield was under 4%. When you stop and think about it, if it wasn't for those storms we had, those hurricanes, housing may be a lot more sluggish today. Might be not looking as strong. So we'll have to see whether or not middle-class America has a stomach for a 70 basis point rise by the 30-year mortgage yield. I'm not convinced. And I will tell you one thing. In my business, we rate corporate bonds. In the high-yield corporate bond market, that issuance has gotten clobbered by the financial market volatility of February.
That's very true.
First few weeks of February, it's down 50% year over year. Maybe that's a sign of trouble down the road with the real economy.
Wow.
Especially
Are you
housing.
worried about that, Mitch, when you hear that stuff?
Not entirely. I think, and we were talking during the break, volatility is new, so people have to sort of cope with it. But everything's happening so gradually and measured. So the first time you see a spike in rates, the market freaks out, the market sells up. Once they digest it, the indigestion kind of goes away. They take a Tums and they're not as
but they
sick
like
to their
think
stomach.
We're over the worst of it. The 6 days where we were getting shellacked, that's it.
Well, what happens is you also have computers making trades based upon things that happen sort of off the grid. And then when that sort of settles down and human beings kick in, I mean, we had that day that there was news in the morning, the CPI day, and then it was sold off immediately and the market closed up. Once human beings sort of step in, more normal behavior sort of kicks in.
But the human beings made those computers that do that 2001 Odyssey thing. Let me get your take on the sentiment that's building out there. We know people are thinking much more positively about the tax cuts, right? And we do know that they've been a benefit to the economy, so much so that even Democrats are admitting that, they're helping. But offsetting that, higher interest rates. Now, they're good if you're a saver and you can get a higher yield in your CD or savings account. Bad if you're a borrower, offsetting whatever gains you're getting on the taxes, right?
That is a major concern right now. And we have 2 camps coming out today, the whole Morgan Stanley line of thought here. The main course, the downfall is going to come in the second half of the year. If rates and inflation rise too much, the economy can't handle it. And then you have everything BlackRock said. They're very bullish on U.S. equities. They upgraded them to overweight. They like financials. There's your rate story. And they like technology, too.
What do you think, John?
Well, on the inflation front, the same day the CPI came out, we had a report on retail sales. Retail sales were down, and when you add to it the jump in inflation, that means that real consumer spending fell for the month of January.
So that could be stagflation.
Yeah, it sounds like stagflation. It's not good. You mentioned a magic word, savings. The personal savings rate in 2017 fell to a very low level. Who's to say that a larger than expected portion of these tax cuts that people receive will be saved and not spent, especially with the population getting older, especially with the workforce aging.
Yeah, there is that.
And the year ended with the trend of saving less and credit card debt more. Hopefully, when Americans start getting those refunds coming from less withholdings, and also these 4 million Americans who got their crumbs. Hopefully that money goes into savings and they'll be saving at a higher rate. So it could be a good thing for our economy.
Does the market build in the possibility that Republicans lose the House? Or is that a given? Does it matter?
Political uncertainty.
Gridlock is good.
Yeah, definitely.
Yeah,
I'll tell you, when we talk to traders, when we talk to CEOs, they're very concerned about the midterm elections. And they've been that way, and their level of concern is increasing as we get closer and closer to the midterm.
Just look how the market moved on Friday after the indictments. You know, it came down a little bit.
Remember the initial read was bad for Trump, and then they said maybe good for Trump. And that is true. All right, guys, thank you very, very much.